Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player. Good afternoon. Ira Epstein of Linn and Associates with your financial market update for this Tuesday, the 9th of May, 2017, and we're about 4:50 p.m., not even that, 4:40 something p.m. Central Daylight Time. We haven't lost the boards behind me, and that happens at 4:45. We have different worlds going on here. We have a market where the NASDAQ is the powerhouse, and I keep saying that it's the poster child of this bull move, whereas we're starting to weaken a lot in the S&P and the Dow, and the Russell's looking ill. You've got different worlds. If you also start looking at how many markets in the S&P, for example, are over the 200-day moving average versus under, you start getting concerned. You're hearing noise from Mr. Blankenfein of Goldman and other companies saying that they are concerned that complacency is shown by the VIX as to what it's done, although the VIX did come back and close 19 higher today, but it hit a 23-year low yesterday. The gold market finished down 11, but prices actually at the end of the day were trading over the 1220 level on noise again about North Korea. And they have come out and said they're preparing now for their 6th nuclear test. It can happen at any time. That put the stock indices down, kicked the gold up, but you don't see that because a lot of this news comes out, as you know, after settlement prices are determined, even though the market is trading. Where we have power has been in the dollar index, especially against the yen. The yen down 100, the dollar index up 60. That's the currency pair people are really trading aggressively. And part of that apparently has to do with the thinking that you've got the situation in France resolved with the presidency. South Korea's president's been decided. We don't know about North Korea, but it's been a wild card out there forever. We realize that there's an 87% chance, according to the CME group, that interest rates are going to go up in June. And people are starting to look at the difference between what U.S. interest rates will pay versus interest rates in other countries. The stock market, a lot of concern that the valuations are high. Disney had good numbers. We'll see on the reopening how that all works out. When we come to the weekly chart, it's just straight up and away. I think you see that clear as can be. And this is what, a 1,020-point lead? Unbelievable what the market has done. 1,120-point lead, actually, as I'm looking at 1,130 points. Almost straight up. Not completely so, but almost when you look at the weekly charts. This was the break, and this was the day of what? That was the presidential election when President Trump got in. The market at first broke down hard, came back. That was an outside day up, and from that day on, you never took that low out, and the market has worked its way to higher and higher prices. When we take a look at the NASDAQ on an area chart of closes only, well, you're back up here right now knocking on the door of, a new record high close. You did it. When you take a look at the chart, you can see how nice the action is gone. And when you look at the swing lines, you've got higher lows, higher highs. So until 5603.75 is taken out, the current chart pattern looks very strong. Then we look to see where the key moving averages are, because so many people look at moving averages. Remember, they're a laggard and reference points on a chart. In this case, the 18-day is well under the swing line low. If the market went down for that support, it would break its current uptrend. That doesn't mean to go into a bear trend, but this phase of this run would end. So that's not going to offer a good support number at this point. Resistance-wise, the upper Bollinger Band keeps moving higher than current prices, and when that happens, you either get a surge toward or it just plain works in a way that you don't come back to it and then the market eventually corrects. That's what you've got to watch. And there is an art of watching what Bollinger Bands do. I look at that art as part of the slow stochastics, the oscillator where I believe that momentum leads price. And you still have this oscillator acting very good, still pointing to the upside. So until it's over, folks, it isn't over. When you get to the Dow, you also have an embedded reading. Now, embedded means you have at least 3 days where the K line is over the D. So you got it there, you had it the day before and the day before. Here's the day you don't. So today was your third day. Until the red line crosses under 80, I say the market will be well supported on breaks. If it gets under 80, the bulls could disappear on you like that, and prices might head back towards the 18-day average to regroup. The S&P is the same thing. And yes, these markets are coming off those highs, but there's no reason to be bearish on them from a technical point of view just yet. Then I look at the Russell, which has been the weak sister, and it's got a pattern of lower highs, lower lows with momentum pointing down. This is the weakest. Now, when you're looking at bull markets, the one thing you don't want to buy is the weakest of the group. You want to be with the leadership, not the absolute weakest. You may pick a second tier, but I wouldn't go much into the third and fourth tiers because they don't get the pop the way if the market keeps going in the trend, the others go. Sometimes they even react worse on the corrections because they're already in the potential for a downtrend. If this market slips under the 18-day average, next support's 1373.90. So far it hasn't been able to do that, so we have a neutral market there. We then get to the VIX, which has a fully embedded slow stochastic. It, too, has a pattern of a higher high and a lower low, so not the ideal pattern here, but you've also had a bearish crossover. And a lot of people are saying, you know, if this thing's at these lows, is everyone just too complacent about a potential break that can happen at any time? Some are doldrums. The word sell may go away. It doesn't have to work, by the way. It hasn't been the greatest in recent years, especially in this all-time bull market that we're getting. But those thoughts are there, and that is why you're seeing all these top market analysts and owners and directors of trading firms coming out with the words caution, and they're starting to move. Even it's Mr. Tice reopened his bear funds, and he's been out of this game for a while because he is seeing opportunities in his mind that this market's overvalued and you could be there. I am not telling you the bear market has begun. I'm not telling you a correction has begun. I'm telling you the warning signs that are out there. We then get to interest rates. And as you can see, they are coming down. Now, generally, as interest rates come down, it's a question of time to when inflation picks up. Why? The reason is because this is a harbinger that things are getting tighter in an economy. You don't raise interest rates unless you've got an economy that's improved, a wage force that's doing better, blah, blah, blah. So as rates keep, at this point, getting higher, that could be a sign that underneath all this, something else is occurring. I haven't seen it in the commodity complex yet, but you're always aware of it. At this point, you're running the lower Bollinger Band in an oversold condition. The TLT, you went down today in this ETF to the 100-day average, the lower Bollinger Band, and you held them. You got down and challenged, as you can see. You just missed the lower Bollinger Band, and you bounced away from there, but you're knocking on that door. Now the question is, what does it do? The 10-year note's oversold in a downtrend. No interest in that. And the dollar index has zoomed to the upside. Is the new thinking is, and remember, these things change on you very fast. Okay, since we now know that the situation in South Korea's got a liberal that is becoming the president, no longer the Conservative Party. Since Mr. Macron has won in France, that's a sign of good. We've seen so far in the German elections, Miss Merkel's party doing better. There's a big election coming up shortly. I think it's in the northern part of Germany, and we'll find out how her party does there. And we are looking at stock market at records high, 4.4% unemployment in America. Why is the dollar down? So the dollar's jumping a little bit, but not on the news of a Donald Trump play, just because of, I think, interest rates in the economy at this point. At the same time, the euro might have gotten ahead of itself, and like we saw when we had the U.S. elections and the stock market bottomed on Mr. Trump, President Trump, maybe this market peaked out on the temporary at least, maybe it peaked on the French elections, and it wants to work its way down. It certainly lost its embedded reading. It should be challenging that 18-day average of closes, if not lower. So warning signs there. British pound. Even though the market was trading over 129.50 in the final minutes of trade, you lost the embedded reading on the close. It either gets it right back or you got to scoot if you're playing the long side of this market. Could get a little ugly if you're a slow stochastic trader. If you're not, I don't know what you're doing with it. That's up to you. In the Japanese yen, the trend is locked into a bearish embedded reading, lower highs, lower lows, just running this market down. A lot of pair traders think you're going to 116, 118 in the end. I don't know. I just know you're in a bear trend, and the market's just now gotten its first couple of days underneath the 100-day average of closes. We'll have to see where that all ends. Then we get to the WTI crude, and let me tell you, this is not a pretty picture. Why? They just came out with the API numbers, and there is a net draw if you add distillates together with the crude oil draw, and add the gasoline. The problem is the gasoline stocks went up 3.2 million barrels. This is not what the market wants to see. It is the problem for the market, and it's weighing on it. Now we have to see in the morning how the EIA report. If the two fight each other and you get a draw out of EIA, that would be a good thing and maybe offer traders an idea that you are getting some support. But this chart isn't looking good. I'm going to look at today's high as a technician and say you have an outside day down. If you take out this day's high in the next two trade sessions, and ideally if you lose the embedded reading, watch out, you probably can make a run towards the 18-day average, wherever it is at that point in time. So that's one thing. But the bears are controlling the move. You do understand that. Until you take that out, they've got the day as far as I see it. Nat gas climbed back up into a big resistance area, the 18, the 100-day average of closes. It needs heat. It's that simple. When the warm weather kicks in, this could all become a base as normal demand starts taking the market higher. The cities get warm. Everybody's turning on their air conditioners, and away you go. As you see behind me, the boards have cleared. Now, don't get away, because I have a special offer for you with money. I hope that got your attention. I want you to write down IRA 20. If you're interested in subscribing to my research, and many of you have in the past, and you drop out for whatever reasons, you want to come back, well, I make an offering every now and then. I don't do it real lot, and I'm doing it now. We have an active period in spring coming against now. We've had markets moving all over the place. Let me tell you what you get. My normal 30-day subscription, and it's a calendar day, in other words, it runs 30 days, is $60. With the IRA 20, you take $20 off it. If you have a trading account with us and you want to come back and subscribe, a $40 subscription, because you have a trading account with us, becomes $20. Just put in IRA 20. It all works pretty simple. So you're going to get access to my video in the morning, which I think is everything. Over this past 12 months, it's become more important to me, that morning video, than all my other research, because I'm able to talk and just throw myself into it. Here's what I think the pros are doing. Here's where they're going to do it. The idea is to give you ideas. I'm not trying to manage your money. I'm trying to throw out trade ideas based on the charting techniques you see me talk with here. But because I can't do that on YouTube and the like, I have to do it according to the government in a controlled area that the general public cannot see, because I'm saying buy here, sell there. Call us. Go to our website. If you go to the website, what you're going to just do is go down to Ira's Research, become a subscriber, click on it. You'll see when you open that up, it'll ask you, are you a client or not? Then put in your coupon code when you click one of the happy or frowning faces. If you want to click right here, watching me on YouTube, click that. It'll take you right to that page. Or under us on many of the websites, you'll get into an area that's just our free offers. That won't get you the subscription in most cases. I'm Ira. You have yourself a great day. Take advantage of the offer. I'll be seeing you tomorrow.